Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today I'm going to go over some oil information. This is from Eric Nuttall. It's a article that he wrote. I just took snippets from it so you guys can get the main gist, I guess, of the article. And we are continuing to draw down on inventory for oil. So let's take a look at what we've got here. We've got oil on the right-hand side. This is crude, gasoline, and distillate inventory deficit to the 4-year average. We are continuing to eat into inventories. It's still declining. We have to have this turn around at some point, and we're using the Strategic Petroleum Reserve to kind of slow this move down. This is what it is down here. It says oil piggy bank. By October, the U.S. Strategic Petroleum Reserve will shrink to a 40-year low as the White House taps it to put a lid on global oil prices. And you can see this thing getting drawn down. Here's the mix. Medium sour crude is really what they're hitting hard, with a little bit of light sweet crude. Now, from the article, looking at this, I'm going to read through it a little bit. There's some important points here. It says, we have for more than a year argued the world was hurtling into an energy crisis of epic proportions that would result in a multi-year bull market for oil. Our bullish thesis had 4 basic tenets: persistent demand growth for at least the next 10 years, the end of shale hypergrowth in the United States, defined as shale production growth rates that are no longer exceed global demand growth, stagnant production growth from the global supermajors resulting from 8 years of insufficient investment, and finally, the exhaustion of OPEC spare capacity. In this keynote speech, Barkindo warned that OPEC is running out of capacity, and that with the exception of 2 or 3 members, all are maxed out. Further, the world needs to come to terms with this brutal fact, and that it is a global challenge. In May, Amin Nasser, chief executive of Saudi Arabian oil company, said it would take what is regarded as the most sophisticated oil company on the planet 5 years to grow its capacity by 1 million barrels per day. He was quoted by Reuters saying, "If we could do it before 2027, we would have done it." This is what we tell policymakers: it takes time. If Amazon Prime is the equivalent of a short cycle U.S. shale production with near immediate delivery, then the equivalent of the long cycle production of OPEC and the global supermajors is a slow-moving transatlantic cargo ship. It simply takes time, usually 4 to 6 years, to bring on large, very expensive projects. This is why we believe we are in a multi-year bull market for oil. It's all about cycle time and the possibility that further demand growth may not be satisfied. With oil inventories already at multi-year lows, demand back to pre-COVID-19 levels, and structural challenges to supply growth, we believe oil prices will have to act as a demand-destroying mechanism, rising to a high enough level that kills discretionary demand, thereby balancing the market, while also staying there long enough to give the supermajors the confidence needed to start adequately spending again. Given industry cycle times of 4 to 6 years, we believe that oil companies are set up to return egregiously high returns to investors for much longer than people realize, leading to a re-rating from valuation levels that still imply the end of oil is near. So that's what I've got. I wanted to touch on that. Why are oil prices going down? We had a big sell-off Friday. Well, things get caught up in the overall markets. Things sell off. Natural gas also sold off from a LNG terminal going down. Are those things foreseen? Not really. There's no way to really position for that. And, would I be purchasing oil at this second? Tough to say, guys. With that large sell-off Friday, there is a lot of momentum heading lower. Now, could we have a pullback in it? We could, but here's the thing. Our inventories are getting eaten up. The fundamentals of oil are probably as strong as they've ever been. This could, and we have very thin capacity. this could make the 1970s look like it's nothing. Because what's happening is we hit peak oil in 1970s in the United States. The world still had millions of barrels, like 3 or 4 millions a barrel for spare capacity. Right now, we are hitting nothing. So what's between us and demand is just inventory. And once these inventories dwindle down, I don't know what price is necessarily going to do. I don't know how high it's going to go. We've never been in a scenario where we've eaten through inventories and we've eaten through all the spare capacity. That's never happened in anyone's life since we started using oil. So I guess the imagination is as far as the limit can go, I guess, and wherever the pocketbooks may end. But we've talked about this before, Scott and I, that there's a lot of liquidity in the system. So we have to burn through that as well. And perhaps that's why the Federal Reserve is trying to raise interest rates. They're trying to kill the housing market, I think. That's what they're trying to do. They're trying to basically stop the liquidity coming into the system. But that's only one aspect of money getting transferred into the consumer price index. This is the other thing, which is oil. And oil is tight. It is very tight. And I don't know what's going to happen, second half of 2022 and then the summer of 2023. As we eat through our inventories, I don't know how they're going to build this all back up. It's going to be tight for a long time. So I do agree that we're going to have a multi-year bull market in oil. Now, again, short term, could we have a pullback? Could we pull on back and have a consolidation? We very well could. And there's nothing necessarily stopping that pullback. But you're going to have to ask yourself the question, how do I play this? Do I ride through it? Should I wait? Should I buy a little bit now and cost average in? That's all questions that you're going to have to ask and answer yourself. I don't have those answers for you. I can't give advice or anything like that. But what I'm doing is I've got my positions from 2020, and I'm going to sit in them. And I've been accumulating. There's companies I've got my eyes on where I'd like to pick them up, pick more up in it. There's also a bunch of opportunities in energy service companies and where they're finding this oil. A lot of offshore finds going to go down the next 10 years, I think. So there's going to be a lot of demand for offshore drilling, I think. If you guys are interested in joining the website, you can do the Platinum membership. I go over all of those particular companies, the ones that I like. One just came back off of bankruptcy, where they basically wiped off the bad debt, and I think it's going to be probably a pretty good investment. It's got a good high chance of doing very well over this next commodity and oil bull market. So that's what I've got for today, guys. If you like the content, give me a thumbs up, subscribe to the channel, and we'll catch you next time. This is Finding Value.